right, Shawn, welcome to the program.
Thank you.
Let's get your take. You're in the camp that the Fed's buying program may be larger than $500 billion. How are you preparing in terms of market reaction if that happens?
Well, $500 billion is kind of the norm that's out there. I think they're going to have an inference that it could be bigger if things don't work out as well as they anticipate. That would mean the curve would definitely flatten from the long end.
Okay, and what does that mean in terms of the bond market? What should we be watching in terms of yield moves on various maturities?
I think the short end of the curve is pretty much locked in. 2 years at 34 basis points. So really it's about the 10-year, the longer duration part of the curve. What does that look like? And hopefully that drives down mortgage rates as well, which hopefully stimulates the economy.
Right. There's a big debate on whether or not this additional round of stimulus will impact the economy, but you think perhaps in the housing market, give us an explanation in terms of how it will work.
Well, the Fed is in a tough spot. They're pushing out a string a little bit, but really what they're trying to do is force people out the curve, and that means that you're looking for other assets that are probably a little bit more risky, which in turn facilitates the flow of money, which creates hopefully a bottom in some of the asset prices that are out there. And everyone's biggest asset, at least from a typical standpoint, is their home. So we need to get a bottom in housing to at least jumpstart the economy from there.
It's a unique week. We have the elections that are over with now, the Fed today, and the employment report on Friday. You're watching that, I know. How important is that in terms of what we're going to see in the bond market?
I think the employment number is always a big number. It's the biggest number every month. Certainly it's looking for the trend that's out there in place. No one is expecting it to be an easy fix and a quick turnaround, but certainly you'd like to see the numbers going in the right direction.
Right. And I know as a firm you are hiring. It seems unique that you're in the camp that you're hiring as we're still emerging from a recession. Where are you adding workers, and how many workers are you going to be adding over the next couple of months?
We're pretty much adding people across the entire curve, across the entire globe as well. So we look at this as a great opportunity where the large financial institutions clearly are going through financial reform. Basel III is coming. There's certainly going to be other issues that they're going to have to deal with. Smaller firms can't get economies of scale. We're right in the middle, which we like, and we're going to continue to grow as fast as we can.
Along with the debate about the economy, Shawn, there's a debate about the bond market. Where are we? Can bonds continue to rally? A lot of people say it's over.
In a World Series analogy, I think we're in the 7th, 8th inning of the rally. It's been an extended period of time as far as this rally is concerned. But, you know, short end's locked in. We're at 35 basis points. We really can't go much lower than that. Long end, you could see some movement, but I think it's going to be a volatile go. You may go down 25 or 50 basis points from here, but I'd be looking to sell into any strength at this point in time.